Welcome to the Silver Change Chronicles. This is a safe space where we believe finances don't need to be complicated. In this video, we're breaking down savings accounts, what they are, how they work, and how to make them work for you. What is a savings account? The simplest definition of a savings account is a bank account which earns interest on the money kept in it. While checking accounts are for daily purchases, savings accounts are designed to hold your money. While interest rates vary, funds tend to be easily accessible, making the accounts ideal for emergency funds and short-term goals. Types of savings accounts. Traditional. These are easy to find and open at most banks and credit unions. Fees tend to be low, and typically it's easy to deposit and access your money. These accounts are insured up to $250,000 by the FDIC. Unfortunately, interest rates also tend to be low, and you may be limited by the number of monthly withdrawals you can make. High yield. These are very similar to traditional savings accounts. They're also available at many credit unions and banks, particularly those that are online only. They may have low or no fees and may require a minimum deposit. These are also insured by the FDIC, though they offer a much higher interest rate than traditional savings accounts. Money market. This is basically a hybrid checking savings account. They typically require a higher opening and minimum balance requirement than traditional savings, but they also offer a higher interest rate. They may offer debit or ATM access or allow you to write checks. These accounts are also insured by the FDIC. Check with your financial institution for their specific requirements for any accounts you're considering. There are, of course, other types of specialty savings accounts such as CDs, IRAs, and health savings accounts, but we'll save those for another video. How does interest work? Most savings accounts earn interest in exchange for giving your financial institution permission to use your money to loan to other people. When we talk about accounts earning money, we're talking about interest or APY. These terms are sometimes used interchangeably, but they're not exactly the same thing. Interest rate is the rate at which interest is earned only on the original amount. APY, which stands for annual percentage yield, is the total amount of compound interest earned on that money over the course of a year. Here's an example. Say you have $10,000 at an interest rate of 4% paid after 1 year. 10,000 times 4% equals 400. This is also known as simple interest. Now take that same $10,000 with a 4% interest. Remember, APY is the interest rate after compounding, and it's usually done monthly. So at the end of month 1, you've earned about $33.33 in interest. So now you have $10,033.33. At the end of month 2, the bank calculates your interest on this amount, and the interest earned is $33.44. Add this to month 1's total, and you now have about $10,066.77. If your interest continues to compound each month at the same rate, at the end of the year, you'll have about $10,407.42, and your APY is about 4.07%. Remember, the key difference between APY and interest rate is that APY includes compound interest and interest rate doesn't. How to maximize your interest. Save regularly. Look, I know times are hard right now, but even putting $50 a month in an account towards an emergency fund helps. $50 a month in an account with 3% APY gives you roughly $609 at the end of 1 year. Avoid unnecessary withdrawals. Once you save your money, don't withdraw it unless it's a real emergency. Paying for a new tire after one blows unexpectedly is an emergency. Getting your hair done is not. Even small balances grow with consistency. If you can't afford $50 each month, save $25 or whatever you can. Any amount put into savings ultimately puts you in a better position financially, since you never know what will happen. Tips for growing your savings. Automatic deposits. This is actually what I do. I have my paycheck split, so a certain amount goes into my savings account each pay period. Since I don't see it, I never miss it. Treat savings like a bill. Some people deposit a set amount into their savings account each month just like it's a bill. When you think about it, it is sort of like a bill. You're just paying yourself. Separate savings by goal. Your first goal may be your emergency fund. You may also be saving for a new garbage disposal. Next, maybe a weekend trip. Whatever it is, keep the funds separate so that when you reach goal 1, you can put more funds toward another. Stay consistent. What I mean is, no matter how little you think it is, save something. Even if it's $5 here or $10 there. Every little bit helps when you look at the big picture. So, to sum it up, a savings account is a bank account which earns interest on the money kept in it. A few types of savings accounts are traditional, high yield, and money market accounts. The key difference between APY and interest rate is that APY includes compound interest and interest rate doesn't. You can maximize your interest by saving regularly, avoiding unnecessary withdrawals, and honestly, just saving whatever you can. You can grow your savings by automatically depositing funds into a savings account, treating savings like a bill, separating your savings by goal, and staying consistent. Well, that about wraps things up for today. If you made it to the end of this video, do me a favor and put a $sign in the comments. If you haven't seen it yet, check out the first 2 parts of this series on checking accounts. Next up, we'll be covering emergency funds and why you need one. As always, if you learned one new thing, go ahead and hit that like button. It's totally free and helps me out a lot. If you learned 2 new things, hit that like button and tell a friend about us. We hope to see you here again at the Silver Change Chronicles, where we believe finances don't need to be complicated.